Hi and welcome. Thanks again for this session. What I want to say now is that, I've tried as much as I can to get some quality videos. Forget about the quality of the video, the quality of the content is more important. So, we continue with our enterprise risk management. What we are looking at now is financial risk management. Of course, we cannot tackle financial risk where we are dealing with numbers, with figures, with quantitative metrics without considering some basic computations. Okay, so financial risk management is a whole chapter on its own. It's a whole module on its own. Let me put it that way. And we cannot just take a session to finish it. So whatever we are doing now is more of an introduction, just an overview, a tidbit. Okay, so that those of us who want to take it as a further study will just have the appetite to launch into it. All right. So financial risk management is more or less what we are doing now is more or less an introduction. Okay. Mostly it deals with the financial institutions, but of course, in the wider context, we can also apply it to um, any organization that generates income or that holds income, that holds cash. Let me put it that way, that holds cash, that manages funds in any one way or the other, whether for profit or not for profit. So whatever we're studying here can be applied or can be replicated, extrapolated to any other operational dimension, any other operational firm. So we'll split the study into two as usual so that the the recording will not be too boring to listen to. Okay, we want to try and split it into two different halves so that we can have time to peruse it. Some short videos will always help. Okay, so as usual, if you have any challenges, any questions, please revert to myself and David, and we'll see how best we can help. All right. So financial risk management as our next topic. What we'll be looking at within this session for the next two videos that you'll be looking at, like I said, I'll split it into two. So what is the concept of financial risk? What are the major sources that give rise to financial risk? We'll also consider the various types of financial risk. And we'll center more, we'll focus more on market risk and then liquidity risk. Okay, with some few computations. So under market risk, we look at the value at risk. We also consider the expected shortfalls. Okay, and then like I said, we'll look at liquidity risk in light of the lessons we've learned from the financial crisis and how the regulatory bodies, okay, like the central banks and financial conduct authority have come in to regulate issues so that we don't get into that situation again. So we'll look at two major ratios which were proposed, okay, um, to help salvage this situation from ever happening again or to prevent it from ever happening again. So we look at the liquidity coverage ratio and then the net stable funding ratio. Some books will refer to it as net stable funds ratio. And then we look at three lines of defense for managing financial risk. Okay, internally, supervisory, and then externally from audit and assurance perspective. And then we look at the framework of risk management. Okay, and how we can apply it to financial risk. This framework seems to be generic. We can apply it across board in all risk management or enterprise risk management dimensions or perspectives. We also look at the roles of the FCA and then Prudential Regulatory Regulations Authority (PRA), and then just try to introduce some basic complexities. Is quite paradoxical to use the word basic complexities in retail investment activities, but we'll look at it. Okay. All right. So let's look at financial risk management. What do we mean? Okay. So financial risk, typically we are talking of the exposures to any uncertainty. And at this point, we understand what risk and uncertainty means. Okay. Which are created by both internal and external shocks or factors that have the potential to cause any negative financial position or negative or adverse financial performance in situations where our controls may not be existent or in situations where our controls may not be monitored or implemented effectively. So most of the internal factors are specific to the organization, but the external factors are those which are outside the control of the organization. So talk of external factors like market shocks, okay, changes in market and price volatility, client behavior and regulatory changes, even natural disasters which could occur. Okay, whereas the internal factors talk of balance sheet composition, trading strategies, and product offerings, product pricing, which we have implemented. Okay. The impact of these factors are usually managed within the firm's management functions through some good corporate governance practices, controls, oversight activities which are put in place. Now, in the financial services sector, investors will always try to weigh these financial risks. Okay, the idea is that they want to generate more returns, they want to remain competitive, they want to reduce any risk that could affect their returns. There could be problems that may arise when decisions about investment activities are made, especially when I don't understand, as an investor, I don't understand how the impact will be. Okay. And once this risk occur, where I tend to lose adversely, there could be some resulting consequences on both the firm's reputation and even the performance of the firm in the whole market. Okay. So in terms of meaning, financial risk, like we just said, any element of uncertainty that affects financial decisions or financial actions. And once these decisions materialize, they tend to result in some threats of losses to the organization. Okay. So any financial decision the company makes, whether a financial institution or a non-financial institution, whether a profit making or not for profit, which results in some losses, okay, financial losses. Now, we will always look at the exposure to the risk by looking at the probability of the risk occurring and the probability that if it results, what is the magnitude of the effect on our financial performance and our performance and our financial position. Okay. So, like I said, financial risk could arise from two sources, the internal and then the external. Okay. So, the external, those ones which are out with the organization, and they could result in like political events. Examples could be like political events. The Brexit has had some financial impact on companies. The recent situation of gas prices, where companies least expected this to happen, has caused companies to collapse because liquidity issues. So some of the things which occur outside our control, where we cannot control, global economies, the COVID has also led to a lot of companies collapsing. So these are all risks which came because they couldn't keep up. They couldn't keep up with their cash or funding requirements or liquidity requirements. Okay. Internal ones, like I said, specific to the firm, maybe shareholder decisions not right, governance, corporate governance decisions, institutional investors withdrawing, customers not patronizing our activities or our goods and services, and then some operational compliance issues and financial arrangements which do not augur well. Okay. So again, the sources, like I said, it could also be a blend of both an internal and external sources. Okay, it could also be a blend of the two. So we can consider these examples given from external factors, market volatility, changes in price regulations, prevailing global economic situations or climate situations, shock events from Brexit, from natural disasters. Okay, internal factors talk of business strategy decisions, product and service offerings and pricing, talk of our internal governance processes, which is affecting any compliance, financial arrangements issue, technological issues within the company could also impact it. Now, we delve into one key area, which we will use it to wrap up for the first section, and that is the market risk. Okay, so there are various types of financial risk. We're talking of market risk one. Now, market risk is the risk that the value of a financial instrument or a security may move adversely due to changes in the market. Okay. When we talk of market, which market? Are we talking of the grocery market or the meat market? No. We are talking of the financial market. Okay. The capital market, the stock exchange, the alternative investment market. Okay. So we are looking at what risk affect this capital market, these financial markets that could affect our securities or cause our financial instruments to move adversely. okay, that to operate adversely. So our returns may drop, may plummet, or we could get our results totally being wiped out. Okay. And examples of some of these changes in the market could be exchange rate fluctuations, interest rate changes, okay, changes in equity prices or commodity prices. So, in terms of technical definition, technical jargon, and I adopted it from Saunders and his colleagues' book, it is simply considered as the risk that relates to the uncertainty of a financial instrument's earnings on its trading portfolio, and it is caused. Why? It is caused by changes in the market conditions like price, changes in the price of the financial instruments, of the of the interest rates, market volatility, market risk. And so they include a number of items, some subsets of this market risk talk of the market liquidity risk. What is market liquidity risk? The more of a financial institution or a financial services sector terminology, where we talk of the bank being unable to liquidate a position because the market is illiquid, okay, or without sustaining significant losses. If they try to liquidate their position, they will incur significant losses. So whether they don't have the funds, okay, to they cannot liquidate their position because there's no funds or there's little funds, insufficient funds, or even if there are funds and they want to liquidate it, they will incur significant losses. Currency and foreign exchange losses, these are risk associated with foreign exchange fluctuations, okay, comparing dollar to the pounds, okay. And it also occurs in the market, in the financial market. Of course, we don't trade these things on the groceries market, let me put it that way. Then we also talk of investment risk. These are risks inherent in any investment portfolio. And then the basis risk. So if you are thinking of undertaking a hedge, for example, so that your losses and your benefits could offset and you could still safeguard your financial position or situation, and it doesn't work out, we call it the basis risk. Okay, so the risk that I'm taking a trade position to mitigate the risk and it doesn't completely offset, I may incur some losses, so I may lose out. Okay. And then inflation risk deals with the risk that our investment does not keep up with the pace of inflation and that the buying position of the cash reduces over time. So instead of thinking that if prices go up, our investment should also move in line so that we could gain. It doesn't work that way. This this occurs when we have inflation risk. Now, in market risk, we normally use one model, basically, okay. But of course, there are other liquidity index or there are other indices which are used to also compute it. But we'll limit ourselves to the value at risk analysis. Now, the value at risk analysis or value at risk VAR estimates that at a 99% confidence level, the potential decline in the value of a position or of a portfolio under normal market conditions, assuming a 1 day holding period, what will it be? Okay, what will it be? So, if I'm the financial institutions manager, having a 99% confidence interval over a 1 day holding period, what will the impact be, assuming that there's a potential decline in the portfolio which I hold on the market, assuming everything is equal, okay, assuming all things equal. Now, VR statistics, they are based on historical data, but of course, they can fluctuate or change across firms because company A's trading portfolio may be different from company B's trading portfolio. Of course, the methodologies in estimating VAR could also change, and the model parameters could also change. Okay, the probability metrics could change. All right. Now, in financial institutions, usually they believe that VR statistics can be more effectively used as indicators of trends in risk taking within a firm, rather than using it just as a basis for determining or inferring differences in risk taken across firms. The most popular VAR model is the Monte Carlo simulation approach or model. And the reason why this is considered the most ideal is because it includes or it makes room to incorporate a wide range of observations so that we can draw accurate, reliable, and then valid conclusions when we are making decisions on this particular line of analysis. So the Monte Carlo simulation VAR model is considered appropriate, like I said, because it's a tool for considering portfolio valuation under all possible combination of factors that may determine the securities or financial instruments value. Now, the VAR has a counterpart that helps us to match up the weaknesses, okay, of the VAR. Of course, no model can be foolproof. Um, Academic researchers will come up, professionals, practitioners will come up with some criticism. So there is the counterpart that helps to bridge the gap for VAR, and that's the expected shortfall, ES. Remember, the VAR is looking at a normal distribution with a 99% confidence interval. What about the tail, the 1%? What if the 1% is very fat and the losses are hidden over there? What happens? The VAR doesn't consider the VAR looks like video assistant referee, right? It looks like it just came to mind. It looks like the Premier League VAR video assistant referees, but that's not what we are looking at. We are looking at value at risk. Okay, so the VAR considers only the normal distribution. What about the tails? Okay, what about the tails? You remember your statistics, the normal symmetric distribution. Okay, so that is the loophole of the VAR. It doesn't consider the tails. So if it happens that the distribution is not symmetric, okay, if it is left tailed or negatively skewed, or if it is right tailed or positively skewed, okay, or if it is 99%, no worries if it is symmetric, but then the tails become too fat, such that the risk are centered over there. What happens? So when it happens that way, for sure, the VAR value at risk will only give us partial information which could affect our decision making. And this was what became so evident during the 2008 financial crisis when assets plunged into the fat tail regions of non-normally shaped distributions. And they couldn't detect it because the VAR couldn't flag it out. Now, these losses in the fat tails or on the tails where VAR doesn't consider, it is only the ES, the expected shortfall, which can help us to detect these. So the ES is sometimes termed the conditional VAR or the expected tail loss, and it depicts the average of the losses in those tails of the normal symmetric distribution. So in effect, if, for example, 1 in every 100 days, there is a loss. Okay, we're saying 1 because VAR will look at the 99th percentile. So if 1 in every 100 days there is a loss, that 1, VAR cannot detect it. But the ES will tell us the average of those 1 in every 100-day losses. Okay, so more or less what we are saying is that ES takes care of what VAR doesn't do in terms of the one tail. An example, simple example, whilst we try to wrap this up. Okay, so consider the following discrete probability distribution of payoffs for 2 securities A and B held in the portfolio of a financial institution. So security A has probability of 50%, 59, and 1. Okay, so as we can clearly see them over here, right? And then probability for security B has also equally 50, 59, but it ends up getting 0.25 and 0.75. All right. Now, the financial institution wants to estimate which of these 2 securities will add more market risk to its trading portfolio according to the VaR and ES measures. First and foremost, we find the expected return on both securities. So simply multiply the probability by the expected return. Okay, multiply the probability of the expected against the expected return. So each against other, and then sum them up. So for security A, when we do the probability, it's finding the expected return, the mean. You know these computations. We end up getting an 80 million. Okay, and do same for security B and gives us an 80 million. What does this tell us? It's telling us that On both legs, the expected returns are the same. And academic research has shown that that is the driving premise upon which the VAR operates. So the VAR then tells us that, well, expected returns for both will be the same. We should therefore expect, with a confidence level of 99%, that the risk return, the losses, should also be the same. Okay. So take note of this before we wrap up with our calculation or computation. VAR will always be identical for both probabilities. Why? Because it fails to incorporate any information regarding the shape of the probability beyond the 99th percentile. Okay, it just limits within. So it assumes a normal distribution. It should be for both. You know, when you draw a normal distribution, one side is a reflection of the other. So whatever is on A should be the same for B. Okay. On the other hand, the expected shortfall will incorporate all points to the left of the VAR. So therefore, the risk you get in A will not necessarily be equal to that of B. Okay, so what happens is that usually when there are losses or probability distribution exhibits a fat tail losses, the ES will become larger as compared to the VAR. So the VAR will give us much more lower market risk as compared to the ES. So in such situations, don't be alarmed. That's what we'll be testing our understanding on basically. So for a 99% confidence in level, we realize that the VAR, okay, why 99? Because at the 99, we realize that the remaining one leads to a loss of 920. Therefore, the assumption is that the remaining 9 should also lead to the remaining 1 for security B should also lead to 920. We'll peg it at the same. What about these elements? We'll normally clamp and assume that everything here sums up to the same. All right, so that's what the VAR does. But for a 99% confidence interval, the expected uh, shortfall gives a different answer. Yes, the expected shortfall tells us that for security A at 99, the 1% leads to what? A shortfall leads to a loss or a risk element of 920. But what about the B? It has two elements, so the 0.25 and 0.75 against the 920 against this. So find 0.25 of this and then 0.75 of this and sum it up. That will be the risk component for element B. Okay. So for A, we'll peg it as it is, consistent with the VAR. But for B, when we work it out, we get a different element. What are the explanations that we can give to this? It means that for both, VAR is identical, whereas the ES finds that the security B has a potential to subject the company, the financial institution, to a much greater loss than security A. Specifically, for example, if tomorrow is a bad day, the value at risk finds that there's 1% chance or probability that the financial institution's losses will exceed 920 million for both security A and security B. However, according to the expected shortfall analysis, it says that if tomorrow is a bad day, there is a 1% probability or chance that the financial institution's losses will exceed 920 million for security A. If security A is within its trading portfolio, but losses will exceed 1508 million for security B if security B is within its trading portfolio. All right, so that's what we should always consider. Okay, that's what we should always consider. Like I said, this is more dealing with a discrete probability distribution, but of course, there could also be situations for continuous probability distributions. Let's take one example to guide us for the continuous situation. So it's early Monday morning. Finance manager of the firm that trades in commodities is considering how to deal with the pressing matter of an incoming tax bill, which the finance manager has to pay at the end of the day on Friday. So historically, the firm would generate 20,000 per day with a standard deviation of 400, okay, the spread of 400. Rather than take money off deposit, the finance manager would ideally like to pay the bill out of the firm's profit. So he's assessing how much cash she can confidently predict as being available to pay the tax bill. This is a real case scenario. Real life, it happens. Being a risk averse manager, she wants to be 99% confident of the amount available. 99% confidence. Okay. For a 99%, you'll be given a z-score. So the z-score is 2.33. Okay. If we give it a discrete, we'll give it a z-score. What amount should the tax manager assume will be available to pay the tax bill at the end of the week? Very easy. So initially, for the whole week, how much do we expect? 20,000 per day times 5, giving us 100,000, right? Daily standard deviation is 400. With a standard, with a 99% confidence interval, z-score is 2.33. So we want to find the spread using the z-score. So 2.33 times the 400 gives us 932. Okay. So for the VaR for a 5-day period is the 932 times the square root of the 5-day, giving us 2084. Therefore, we subtract the total value at risk for the 5 days, okay, of 2084 from the 100,000, and we get 97,914. So with a 99% confidence interval, the manager can expect to get 97,000 to offset the tax bill. All right, great. Now let's quickly run through other types of risk, and we'll cut it off at liquidity risk so that we can continue on with the next video. So we have credit risk. Okay, so credit risk deals with sometimes called counterparty risk. So where the counterparty defaults on obligation to pay, okay, an amount due when it is due, or fails to deliver any conditions as set out in the contract. Okay, specifically we have default risk. I go for money from Bank of Scotland, I'm unable to pay. That's default risk. And I also have the wrong way risk, where a credit institution accepts securities or financial instruments issued by a borrower as collateral for a loan, resulting in the value of the collateral being linked to the credit quality of the borrower. Okay. We also have operational risk, and this results as a result of internal operations of the organization. We will look more into operational risk within the next session. And an example of operational risk could be cyber risk, where people could hack into our system, or we could get affected by some malicious software or ransomware. And then we have the contagion risk or systemic risk. So the risk that the perception of failure of one financial institution creates doubt and fear about the stability of the entire industry. So I'm sick, my entire family is sick. That's what people would think. Therefore, be careful when dealing with the masses. Okay, and this is what led what happened during the 2008 financial crisis. And then we also have the interest risk, sensitivities in interest rates. Okay, settlement risk, again, it has to do with the counterparty, where one person fails to honor his part of the bargain in a contractual obligation. Maybe I refuse to deliver my securities when due. Capital risk, we are talking of our capital adequacy. Is it sufficient? Is it enough? Okay, are we using it as is expected, or we are underutilizing it? And could it affect the overall capital base of our organization? Regulatory risk, where the company or the firm refuses to comply with regulatory requirements and standards, and this could result in fines, revocations of your banking license, or curtailment of your activities altogether. All right. So we also look at conduct risk, where company acts poorly, which may affect their customer, and it could lead to a subsequent risk, which is the reputational risk. Okay. So reputational risk occurred when sometime back in the UK, where banks try to fix LIBOR so that they will just gain, okay? Money laundering activities, illicit banking activities, which could affect them, okay? And then we have legal risk, which deals with documentation risk and occurs when legal terms of a contract are not followed to the letter, or they are breached, or they are not enforced. And it could lead to litigations and some consequences. All right, so like I said, I'll leave it here. We'll continue with the liquidity risk as the next section so that we can get it in 2 different parts. All right, that's good. So I'll see you in the next session. Thank you.